The system today is an income transfer and a wealth transfer from old, fat, bald, rich guys like me to younger, more vigorous people like yourself. Your future has been spent by my future. In North America and in Europe too, my generation voted themselves all kinds of wonderful benefits, but we forgot to pay for them. That bill is coming to rest squarely with you. The net present value of off-balance sheet liabilities, which is to say promises, made by the federal government for things like military pensions, federal government pensions, Medicare, Medicaid, Social Security, exceeds, according to the Congressional Budget Office, $100 trillion, to be growing at $2.5 trillion US a year. Well, that's interesting because gross federal revenues before any expenditures are about $5 trillion a year. The math does not work. Make no mistake, we will never have a public gold standard, ever, anywhere. We will always have fiat currencies that we need to defend ourselves with. The action that you need to take is to invoke your own informal gold standard.
Welcome to the Microscopic Podcast presented by Gold Republic. My name is Alexej Jordanov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. We'll dive deep to understand the forces that drive macroeconomics, financial markets, and the emergence of a new monetary system with some money like gold, silver, and digital assets like Bitcoin. We'll also investigate how geopolitics and power games shape the world we live in, but also what can we learn from history to understand the present and prepare for the future. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at Gold Republic, you will receive 1 free gram of gold. Just click on the link in the description. Today we have the privilege of hosting one of the most respected voices in the world of natural resources and investment, Rick Rule. As the CEO of Rule Investment Media and the president of Battle Bank, Rick has spent decades navigating through the intricacies of commodity markets, offering insights that have guided countless investors by educating them through the booms and busts of gold, silver, uranium, and beyond. Known for his sharp analysis and candid commentary on economic policies, Rick's perspective on the current state of global finance and his predictions for the future are something you won't want to miss. So let's dive into the mind of an investment legend. Rick, thank you for joining us today.
Thank you for that very generous introduction. I will struggle to live up to it, but thank you for it.
We'll take it on face value, and I'm pretty sure it's going to be far from any disappointment of any viewers and fans of you that are out there. One of the first questions I always ask my guests, especially if it's their first time on the Macroscopic show, is the following. What is your most heretical view about the monetary system?
Boy, I'm going to get right to this. I believe in free exchange among people. And I believe that the monetary system should evolve between people to reflect the utility of those people, not the utility of the state. I realize that at age 71, I'm highly unlikely to live to see that outcome. But since you asked me for a heretical point of view, I think mediums of exchange and stores of value should be designed for the utility of people as opposed to the utility of the state. And I think that private currencies would be ideal in the future. Currencies that competed with each other as stores of value, as mediums of exchange, as opposed to instruments of control, instruments of manipulation, which is what I believe the dollar, the euro, the yen, and the renminbi, in fact, all of the state-sponsored specie are.
So that will also tie in perfectly in also the rest of what we're going to discuss later on. And I think you have very interesting views, especially when we talk about first principles. And that's also what I would like to unpack with you in the first part of this interview, and then later on dive more into obviously commodities, maybe the describing what we could see the start of a super cycle, discuss also fiscal policies, both on the part of the U.S. but also on the monetary policy that's been conducted by the Fed. Let's first start with analyzing maybe the current macroeconomic landscape. If we look at the actions of the Fed and the US GDP forecast that is expected at around 2% in 2025, how do you interpret the projections in the context of the global economy at the moment?
Well, I'll start by saying in my 71 years on Earth, those projections have never been correct. They are a reflection both of the political will of our leadership uh, and a perennially optimistic view about both the strength of the economy and the efficiency of government. So let's begin by saying that the statistics are probably meant to mislead. And in that regard, they've accomplished their goal. Americans, at least, are uniformly unaware of the true state of the U.S. budget, and they are unaware of many of the indicators that go into it. I'm not one of those who believe in a broad based conspiracy. I'm one of those who believe that the voters actually want to be misled. They don't want to take control of their financial future. They want somebody else to do it, and they want them to do it in a benign enough fashion that they feel served as opposed to oppressed. Unfortunately, both of those obligations are, if you have any command of mathematics at all.
That actually reminds me of Shadow Stats, John Williams, which I'm pretty sure you're familiar with, which we had the pleasure to interview a few years ago. And unfortunately, last time I checked anything on his website, I couldn't see anything dating more than 2023. So I hope he's still in good health. I know that back then he was already of a certain age. So do you have actually any insights on that, of our contact with John Williams himself?
I haven't visited with John recently. I think that the fact that he has retreated from prominence may have to do with age. He's of my vintage, which is to say less robust than he once was. And the truth is that concern about inflation has retreated in importance among Americans. And so his popularity, when it should be at his greatest, has in fact waned. Unfortunately, in my country, and likely in yours too, government statistics around the depreciation of the purchasing power of fiat currencies is misplaced. In my country, we rely on a statistic which John Williams has done a great job of debunking. That's called the CPI, the Consumer Price Index. Our government would have us believe that it is the measure of the decline in purchasing power of the US dollar. It is in their interest to understand inflation inflation, because the CPI is the inflator or the index that various entitlements are priced again. When there's a cost of living escalator, they use the CPI as the escalator. But let's examine this number. The CPI, first of all, core inflation, according to the government, doesn't include food or fuel. If we had a full body camera, you would see that food is important to me. And any index which doesn't include lunch is of absolutely no use to me, and in fact, most people. Secondly, the CPI is hedonistically adjusted. They don't pay attention to the price that you or I paid for our computer. They pay attention to an index of values that they ascribe to the computer. Finally, and this is hilarious, the CPI as a cost of living index does not include tax. Federal government spending in the United States, total government spending in the United States is about 36% of GDP. A cost of living index, which doesn't include tax, the largest household expense of most Americans, and I'm certain most Europeans too, is absolutely fallacious. If you pay attention to John Williams' statistics, he would suggest that the deterioration in the purchasing power of the US dollar is proceeding at about 12% per annum. My numbers, and they're much less slavishly acquired. My numbers are that the purchasing power of my savings and investments in U.S. dollars means that the deterioration of purchasing power of my savings and investments is between 7.5% and 8% compounded. And ironically, as ugly as those numbers are, they're some of the best in the world. The U.S. dollar, as Doug Casey says, is the worst currency on the planet, with the sole exception of all of the others. So in case the Europeans have a tendency to watch smugly at the internal devastation of the U.S. economy, they can have some comfort, I suspect, in knowing that their own circumstances even a little worse.
So you've just mentioned that you have your own calculation of inflation. Is there maybe a way to detail that a bit further?
Well, what I did was basically look at most of my expenditures, and in a very unscientific fashion. Most recently, in the period 2020 to 2025, I began with the easiest thing to calculate, which was my aggregate tax bill. And any sense that federal, state, and local taxes for me were compounding at 2.6% a year compounded was silly at best. Then I looked at other items that comprised my budget: my healthcare costs and my health insurance, my gasoline prices, the prices of groceries. I don't have a mortgage, but if I did have a mortgage, what would have happened to my mortgage interest rate? Suffice it to say, when I aggregated all those things that I buy, and by the way, I'm a grumpy old retired guy. I don't spend much money. But when I looked at the decline in purchasing power of my savings relative to the basket of goods and services that I spent on, the 2.6 number was absolutely silly. And I don't want to get into an argument, by the way, because I did include taxes, whether taxes were either good or a service. All I'm trying to say is I pay them. And the idea that that number isn't calculated in my household expenditure is silly. It's my largest single expense. In fact, in my case, larger than all the others combined.
Because indeed, taxes are everywhere. When you buy something, when
Correct.
you sell something, when you inherit something, when you want to donate something,
That's
there's
correct.
like the list goes on. You've been taxed everywhere and everything, and before you know it, they'll tax air. That is something that I think is not talked about enough. And paradoxically, correct me if I'm wrong, but government expenditure also contributes to inflation itself.
Right. And inflation itself is a tax. It's important to know that nowhere in the world that I know of are things like capital gains tax or inheritance tax indexed to inflation. So you get taxed on the nominal value of your earnings, but you get to spend the net present value of your savings. And in that sense, inflation is a particularly pernicious tax. There's another tax too, Alexei, unfortunately one charged by me and paid by you, which is to say entitlements. In North America and in Europe too, my generation voted themselves all kinds of wonderful benefits, but we forgot to pay for them. That bill is coming to rest squarely with you. The system today is an income transfer and a wealth transfer from old, fat, bald, rich guys like me to younger, more vigorous people like yourself. In my own country, in the United States, I don't know the European numbers. In my country, the net present value of off balance sheet liabilities, which is to say promises made by the federal government for things like military pensions, federal government pensions, Medicare, Medicaid, Social Security, exceeds, according to the Congressional Budget Office, $100 trillion. $100 trillion. That number is estimated by the same body to be growing at $2.5 trillion US dollars a year. That's interesting because gross federal revenues before any expenditures are about $5 trillion a year. So explain to me how we are going to honor this $100 trillion in explicit promises. This math doesn't work. You don't need to be a quantum physicist. You need to have gotten through grade 3. You need to have learned how to add and subtract and multiply and divide. What you need to understand from a social point of view and political point of view, and when I say you, I mean your generation, is that your future has been spent by my future. And society needs to adjust to the reality that the promises aren't going to be kept. Stop and plan for a future where these promises aren't kept because they aren't affordable. I mean, this isn't a policy discussion. I'm not saying to you, Alexej, that the European voter needs to say to old folks, too bad, so sad, no money, strong letter to follow. What I'm trying to say is we have to figure out how we are going to negotiate a future where there isn't the revenue to honor the promises that we've made, or in fact, honor the current level of on-balance sheet debt and services allegedly provided by our federal governments. This is not a policy discussion. This is not in my country a Democratic issue or a Republican issue. It is simply a statement of fact. The math does not work.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at Gold Republic. At Gold Republic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults, with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at Gold Republic, we offer real assets to safeguard your generational wealth. I think you said it very eloquently. Our future has been spent, and I think I see this already in the thumbnail. It's a very powerful way of expressing this. And when we look at also like the current administration, where Trump just took office, and one of his talking points was to diminish the national debt and to also reduce inflation and having all kinds of policies. I see you already laughing because I kind of assume already what you're going to say. Is this going to make any difference? Is this like already not doomed to fail?
I mean, he might have the right background. I don't know how many businesses he's bankrupted, but he does have some experience at that. He's a real estate developer. He lives on non-recourse debt. And if he regarded entitlements as non-recourse debt, that probably, sadly and cynically, is the way that you have to regard them. Lies that you need to restructure. I'm not suggesting he's the right guy to do it, by the way. If you read his book, The Art of the Deal, Mr. Trump does not seem to believe in win-win transactions. He seems to believe in win-lose transactions. And in my experience, if you have a counterparty that believes in a win-lose transaction, your right response is to walk away, not to deal with that person. Unfortunately for me, that person has guns. He runs the state that I happen to inhabit. Many people are looking at his pronouncements around the Department of Government Efficiency as some way that Mr. Trump is going to wave his magic wand and make things better. Let's examine this. In the first instance, the person he put in charge of it, certifiable genius, has made billions of dollars on federal subsidies. The idea that you have the master of the hog farm in charge of reducing feed to hogs seems rather odd to me. If you still have faith in this, beyond that, I would encourage your listeners to read a book called The Triumph of Politics by David Stockman. David Stockman was the director of the Office of Management and Budget during the Reagan years. And Reagan had an actual mandate, a landslide victory, not a small victory like Mr. Trump had. And in The Triumph of Politics, David Stockman describes how the Reagan Revolution was derailed within 120 days of him coming into office. If you look at the work of H.L. Mencken, where Mencken described elections as advanced auctions of stolen property, you understand the nature of the problem. Everyone believes that government should benefit them and that their representatives should defend them against other interests. There's another great quote, I think it was Gore Vidal, who said that politics could be defined by looking at the root words, poly, of course, from the Greek for many, or polis, but tick from the English colloquial for small blood-sucking insect. If you think about the process as a bunch of small blood-sucking insects, then you understand what the product will be, and you understand the probability of a voluntary reduction in income and wealth transfers through the government.
Yes, and also now to come back now to the inflation question is that when we look at, for example, just gasoline, for example, a big portion of the price you pay at the pump station is actually directly going into a tax that is basically paid to the state. So
That's correct.
In a lot of ways, how much would you then give a percentage of what we consume as attributable to taxes on inflation? Because nobody talks about this, I think, or not enough at least.
Well, I suspect that one way to look at it, and by the way, I'm not a Christian, would be in the Bible. Or if that didn't work for you, in the Quran. Or if that didn't work for you, in the Torah. And the suggestion in theology, in religious cultures, is that 10% of the income of the citizenry should go to the Commonwealth. I'm not suggesting that's the right number. I would suggest to you that the triumph of technology on a global basis means that we can actually do more with less. And I suspect that if you means tested that 10% number from 1000 BC to today, a number that was hedonistically adjusted the way the feds do it, would suggest that the number should be less than 10%. But I personally am tired of hearing myself gripe. So to the extent that aggregate government theft from earners was constrained to 10%, I'd be content.
Okay, so probably the number is much higher than 10%.
I mean, in the United States, government expenditures are now in excess of 36% of GDP. Now, they don't manage to absorb all that back in tax. Some of it they put on a tab, which they're leaving for you. Thank you for that.
Oh, I would like to say you're welcome, but we'll see about that. In terms of now, if we look at more like what's happening in the global economy at the moment, there's a bit of this discussion if inflation has been tamed or not. And the Fed, as we actually speaking at the FOMC today, and that started already yesterday, is going to announce, unfortunately, after the end of our interview, but we can still discuss about this, what they will do. And the anticipation is that they will, given the current level of inflation, and that is still not brought back to the about 2% mark, keep the interest rates at about 4.5, 4.75 of the Fed fund rate. Where do you see this developing in the coming time, and also where are we in the inflation cycle?
Well, as I say, I believe that the true measure of inflation is the deterioration of the purchasing power of the currency in question, in this case, the U.S. dollar. I've already said that I think that the 2.6 number is fiction. And I said why. And I would challenge anybody listening to this podcast to discuss this with me. There is no combination of goods and services in the United States that arithmetically could calculate to 2.6. None. So let's get that out of the way. The question becomes the interplay between the expected yield on one's savings and the underlying rate of inflation. The U.S. 10-year is yielding, by the way, the world's premier savings and investment instrument, the one that every other, this sounds America-centric, but it happens just to be true, the security against which every other debt security in the world is priced, yields about 4.5 a year. If you believe the inflation number at 2.6 and you're receiving 4.5 for your savings, you're not unhappy. You're getting 190 basis points real yield on an instrument where they absolutely will pay you the money, even if they have to print it. If, however, your calculation of inflation is similar to mine, 7.6, never mind the 12% of John Williams, but 7.6 or 7.5, pardon me, you can see the problem. You are receiving 4.5% a year for 10 years in a currency where your purchasing power is declining by 7.5, which is to say that every year your purchasing power is decreased by 3%, which means at the end of 10 years, after you have lent the U.S. government, say $1,000, they give you back something like $650 in purchasing power. Franz Pick described this as a certificate of guaranteed confiscation, not a particularly attractive outcome for savers. Artificially low interest rates, which is what the Fed does, are extremely popular because most people are spenders, not savers. Artificially low interest rates also benefit old guys like me. I have access to credit, and I have a knowledge of how to use credit. So ironically, what artificially low interest rates do is they subsidize old, fat, bald, rich guys like me who can use artificially cheap capital to acquire assets that tend to appreciate in time because their replacement cost increases. In other words, middle-class savers who are relying on the surplus they generated in their productive years are subsidizing old, fat, rich guys like me. And I don't mean to be a ghoul laughing. It's just that the perception of this process is wrong. The fact is wrong too, but the perception is wrong in a very different way. I would prefer that the Fed didn't exist. I would prefer that the interest rate that I was paid on my savings, or the interest rate that I paid when I borrowed, was determined by voluntary transactions between individuals. I don't think that the Fed has any business subsidizing me at your expense. If they're going to err one way or another, I suspect I would prefer them to subsidize me at your expense rather than the other way around. But I don't think that's any of my business ultimately.
And also, like to your point, actually, about the 10-year, I've just on X, on Twitter, I've also come across like this beautiful chart that I'm going to put on screen now of seeing that actually the 10-year is the worst in 90 years in terms of returns in U.S. Treasuries.
I'll tell you what's interesting about that to me. That is that the Fed is actively manipulating the front end of the yield curve, the Fed funds rate. But the market has taken over the long end of the curve, which is to say that yields have gone up in the long-term obligations and down in the short-term obligations. What that means is that individual savers are saying, you know what? The compensation that you're willing to pay me isn't high enough. The last time we saw this was in the Clinton years, the so-called bond vigilantes. We saw it happen in spades in the period 1968 to 1972. And I suspect in that sense, past its prologue. The government had a point of view with regards to inflation, the U.S. government, in the 1960s. And the market came to understand that point of view was fraud. And private savers began to demand more compensation from the U.S. government for the use of their funds over time than were reflected in the short-term markets, which were, of course, subject to Fed manipulation. And we're seeing that again.
And in that sense, when you look at the forward guidance and the way interest rate goes, so you just said that the inflation numbers that we see today, they're basically bullocks, that we cannot trust them, and the bond market is kind of calling that BS as well, right?
That's correct.
If I'm kind of resuming
private savers are saying no, thank you.
Mm-hmm. And that's the power of markets. And I think you've said in earlier also interviews is that in a market, you can basically choose on transaction and freely transact one thing for another, which is the kind of the antithesis for government, where you elect a government, but you don't get kind of like something out of it, because it's basically always tied to the interest of the government itself, which is kind of selfish.
Remembering the Gore Vidal quote, politics. Coalitions of small blood-sucking insects, each seeking to impoverish others while not being impoverished themselves. It's a wonderful, a cynical and wonderful definition of the political process.
If we look at now the way the fiscal policies on the Trump administration looks like, he wants to expand tax cuts, deregulating industries, imposing tariffs, deporting illegal immigrants. How do you think this is going to impact the economic landscape and also the global economy? Because this is also moving towards a more deglobalized tendencies.
Deglobalization is bad, first of all. Specialization is good. We all become richer when we produce goods and services according to our ability and according to others' needs. Let's get that straight. A huge beneficiary of globalization has been the U.S. consumer. When you go to Walmart or you go to Costco, you buy the outcome of production by Chinese citizens who are willing to produce with a lower lifestyle than your own. It's a wonderful thing. But let's examine the issues individually. Tariffs are taxes. Tariffs are taxes. And they aren't paid by the host country. They're paid by the U.S. consumer. If we import subsidized dairy products from your country, we won't go into your subsidies for a while. We'll pick on my government instead. That price is paid by the U.S. consumer. To the extent that that raises domestic prices and it benefits U.S. dairy producers, they like it. They view that as a good. But let's understand that tariffs are taxes, and they're paid by the host citizenry. Now, let's examine cutting government expenditures. Where? Mr. Trump favors a stronger military, a more assertive, quote, defender of U.S. interest. How might he cut entitlement when his principal voting strength is old, fat, bald, white guys? Is Mr. Trump actually going to look into the camera and say to old, bald, fat, white guys, I'm sorry, I'm going to have to cut your entitlements. By the way, vote for me. That seems highly unlikely to me. U.S. immigration has always been a shambles. I myself believe in the rule of law. And I believe that if our current immigration system is flawed legally, then we need to change it. We had until 1964 in the United States a program called the Bracero program, where we admitted somewhere between 500,000 and 1 million Latin American laborers a year with permits to come work in our country during the harvest season and then go home. In other words, they weren't illegal immigrants because they were legal. And by the way, they didn't immigrate because they came up here, they worked for 6 months during the harvest season, and then they went back home with their families and they educated their kids according to their own culture. Worked great, but it didn't survive politics. My own preference, I think, would probably be to deny access to social services to people who are in our country without a permit. I believe that America was built on the talent and tenaciousness of immigrants, and I wouldn't want to reduce that. I wouldn't want to consign ourselves to the stasis that would occur if we denied ourselves the vigor of young, hardworking, aspirational immigrants. What I would like to do is discourage immigration to the United States by people who are attracted to our social welfare system. I would invite my European friends to think about their own communities in the same fashion, but it's none of my business what you do. But we're dancing around the edges of this thing. We're dancing around the fact that if you combine in the United States our on-balance sheet liabilities of $30 trillion net and our off-balance sheet liabilities of $100 trillion net, and we juxtapose that with the Internal Revenue Service's estimate that the aggregate private net worth of Americans is $141 trillion, pretty soon what we see is that if you subtract the aggregate liabilities of 130 trillion from the aggregate private net worth of 141 trillion, there's only $11 trillion left over. And by the way, that $11 trillion number is going away because the aggregate federal budget deficit on balance sheet and off balance sheet is $5 trillion a year. This is simple arithmetic. This isn't narrative. This isn't Republican. This isn't Democrat. This isn't progressive. This isn't conservative. This is simply arithmetic. Now, the other side of the United States, the Democrats, AOC and Bernie Sanders and all those morons, say tax the billionaires, tax the billionaires. Politics of envy always works, except in reality. The aggregate net worth of American billionaires is $5.6 trillion, according to the Internal Revenue Service, who has an interest in knowing. If rather than raise their taxes, you simply stole all their money, took it all, right? $5.6 trillion against $130 trillion, or against the on and off balance sheet, the increase in the on and off balance sheet liabilities of the U.S. government of $5 trillion, you will see that if you stole all of the billionaires' money, it would make no difference whatsoever. We could fund the federal deficit for 14 months. Or we could reduce aggregate liabilities by 3.7, 3.9%. It wouldn't matter. We have a structural problem that we're going to have to deal with arithmetically. By the way, I know how we deal with it, and it's ugly, but I know how we deal with it.
Mm. Well, I wish we could dive deep into that, but I'm afraid we won't have time in the limited amount of precious time that you have for me today. That's why I would like to suggest that we talk about something that is obviously very dear to you and very dear to us, which is gold. And I recently had the pleasure to interview Matthew Piepenberg, who said there is no bull market for gold, but there's a bear market for fiat currency. And I thought it was resuming it quite perfectly, and also good transition, I think, to also what you said earlier, that the value of the money is deteriorating, and that other assets, just like gold, which is scarce, limited, and in demand, is picking up. And we see also recently that a lot of central banks in the last 10 years have been net purchasers of gold and filling up their stockpiles of gold all around the world, not just in the West, but especially in the East, because they smell something is happening. So my first question to you is, how do you explain the surge of the price of gold, especially considering that the dollar has been actually still increasing relatively, that interest rates have been high, and even though inflation has the rate of increase has decreased in terms of fakely measured inflation. If you look at all those factors together, how do you explain this?
Well, your last two observations, while popular, are wrong.
Okay.
Let's get that straight. Inflation in the United States at 2.6 is fiction. It's not true. And inflation in the United States and the aggregation of debt in the United States is probably better, ironically, than it is in Europe and other places. Hence, the US dollar is absolutely stronger than other currencies. That doesn't mean it's strong. It just means in comparison with other fiat currencies, it's strong. Your first two assumptions, however, are correct. The United States government has weaponized the world's reserve currency. We've debased our franchise. We've used the currency and the SWIFT banking system, which is not our property, to impose our political will extraterritorially on other parts of the world. In addition to that, whether or not you agree with Russian policies in the Ukraine, what we did to express our dissatisfaction, when I say we, I mean the US government, not me. What we did to express our dissatisfaction is we stole $300 billion of Russian wealth in US treasuries. Any country in the world who occasionally has policy disputes with the US, and I can't think of any that don't, had to look at that and say, why would we store our wealth in an asset class, US treasuries, that could be canceled at the behest of the US government in a policy dispute? So countries, in terms of a store of their wealth, had to consider other asset classes. And countries, too, that relied on the US dollar as a medium of exchange, when they saw the weaponization of the US dollar, as an example, the imposition of sanctions on Iran in terms of US dollar transactions, in addition to questioning the value of the US dollar as a store of value, also had to question it as a medium of exchange. Now, their problem is, and this is a great unsung problem, which other nations refuse to discuss, although they trust us little, very little, they trust each other even less. And so when China trades with Russia, the trade takes place in rubles or renminbi, which are then converted to dollars. I think this is hilarious myself, actually. And so what you are seeing is the development of foreign central banks' reserves of gold, because their transactions are not going to ultimately settle in their host currencies. And by the way, the BRICS is a joke, a total joke. The idea that you could have a basket of inconvertible currencies backing a master currency is an insanity. My friend Doug Casey says the US dollar is an IOU nothing. He says the euro, by contrast, is a we owe you nothing, given that there's 13 or 14 so-called guarantors of the euro. And the BRICS is a nobody owes anybody anything. I mean, think about a construct of a currency between 25 or 26 nations that often are in semi-active disputes with each other. And think about the viability of that currency. Gold is naturally a store of value in a medium of exchange. And the store of value is going to become important, because although the US voter and the US consumer may believe the 2.6% inflation rate, the Japanese don't. The Chinese don't. They are looking at the same math that we discussed earlier in the show, which is to say they're getting paid 4.5% in a currency where the purchasing power is declining by 7.5%. So they're assigning seigniorage to the US government while being deprived of 3% of their purchasing power annually, compounded over 10 years. It's no wonder that those foreign central banks are increasing their gold holdings as fast as they can afford to do it.
And in that sense, there's been also, Matthew was mentioning this as well, that in China, in the case of China, which doesn't hold more, I think, than 5,000 tons of gold, if I'm not mistaken, officially, based on the World Gold Council. And that apparently, I think, 3,000, is actually in truth almost tenfold to what the actual official account is. What is your thesis on the actual accounting of the gold reserves in the case of China?
I don't have a better source than the World Gold Council. So I'm not in a position to question that number. I have better access to data around other topics that we've discussed earlier. I will say that in my own dealings with CITIC and Zijin, a big Chinese mining company, that I've been told informally that the Chinese government regards the best return on capital employed as investing in Chinese infrastructure or Chinese controlled infrastructure elsewhere. That the gold in the central bank for them is more a medium of exchange than a store of value. They see a higher return on capital employed in domestic investing or in supporting Chinese industry abroad. That's probably a good calculation. But as the Chinese economy grows, their ability to transact outside the US dollar will require a larger float of a medium of exchange. And I suggest that a large component of that will be gold. Even if they translate that gold into US dollars and use the US dollar as a payment mechanism, that the basis of the float, the basis of the ability to transact globally will increasingly be gold.
So, do we then witness a comeback or potential comeback of a certain gold standard in anything that is global trade settlements?
Not a prayer. People who go into government because they want power. And gold reduces their discretionary power. Imagine a politician in your country subjecting his or her family to all the scrutiny that goes into being a politician, enduring the abuse of opponents, and doing so to acquire less power, less ability to influence the outcomes, less ability to punish one's enemies and rewards one's friends. Gold is a constraint on politicians' power. Make no mistake, we will never have a public gold standard, ever, anywhere. We will always have fiat currencies that we need to defend ourselves with. The action that you need to take, the action that Matthew needs to take, is to invoke your own informal gold standard, to act the way that the Chinese central bank does, to have the basis of your medium of exchange simultaneously be a store of value, which is to say gold. Don't ever look for official support. Their job is to run your life. Your job is to defend yourself from them. And one primary line of defense is that you maintain that float which is necessary to sustain your lifestyle, the same way that the Chinese are doing, the Chinese central bank, not Chinese people, in gold.
Hmm. And if we look at commodities in general, we've seen an uptick recently in the last few years. And certainly the trend that we see in deglobalization is also maybe a contributor to a boost or an uptick. And maybe there are other factors that you could share with us. How does the current state of commodities look like? Are we maybe seeing the beginning of a big, long bull market in commodities and maybe even a super cycle?
That's a huge question. The decrease in globalization increases the probability of a recession or depression. So the outlook for commodities is threatened by that. The other side of the equation is that we as a species have done a spectacular job over the last 40 years increasing the real living standards of the poorest of the poor. And when poor people get more money, when they get the ability to acquire more utility, the things that provide utility to them are commodities. They increase their calorie count. They change their mode of transportation from barefoot to a Toyota Hilux. They put a steel roof where a thatch roof had been. The wonderful commodities bull market that we saw in the decade 2000 to 2010 was all about the urbanization of China. It was about lifting 500 million people from abject rural poverty to a middle-class lifestyle. And it's happening around the world. There's 1 billion people around the world that have no access to primary electricity. And I think they're going to have it in the next 25 years. That's going to require a boatload of copper, as an example. And over the last 30 years, we as a species haven't invested enough money in the means of production around commodities. We've underinvested in oil for 30 years. We've underinvested in copper for 30 years. Our production decline, the reduction in our capacity to produce, will be inexorable for 5 to 7 years, no matter what we do today. The price will be really a function of, will there be a global recession or depression that will limit demand in the interim, because supplies will certainly fall. The biggest copper mine in the U.S. is something called Bingham Canyon, 160 years old. In fact, if you look at me, you have an icon for the world's copper mines. 70 years of age, fat, bald, past my prime. We need to replace one Bingham Canyon every year for the next 10 years. And we aren't doing it. There are inexorable supply decreases coming up. The question will be, what will demand do in the near term? Zero doubt in 20 to 25 years, the ascent of humankind, the demographics of the poor people becoming less poor, will support demand. The question is what happens in the next 5 years. Do we see trade wars? Do we see de facto or de jure limitations on global trade, which make everyone poorer? If that happens, the probability of a liquidity crisis, the probability of an unsynchronized global recession, that would be very difficult for commodities markets. I'm betting, personally, that we muddle through this. I'm betting that our individual initiative and our individual wants for the betterment of our families means that the politicians' abilities to constrain us won't be successful, and that we'll form voluntary relationships between ourselves, despite the wishes of the Trumps and the Merkels and that noted energy physicist, Greta Thunberg. My hope is that we as individuals preserve the world. And if that happens, the outlook for commodities, because the supplies will decrease inexorably for the next 5 to 7 years, will be very good. That's the way I'm betting.
So when we look at, let's say, silver in particular in that case, do you see it also with the factors that you just mentioned? So it all depends of if obviously we are going to witness a big deglobalization trend that will actually not be good for the global economy. But if, let's say, we're as optimistic as you are and we muddle through this, how do you see the evolution of the price in silver? Will it catch up with the growth of gold through, I don't know, industrial use or like the green revolution, as they call them? Or how do you see this happening?
Other questions that you've asked me, I've been able to answer with arithmetic. I've tried to do that with silver for 50 years, unsuccessfully. An observation. In my experience, a precious metals bull market is led by gold. The first buyer is the fear buyer. When the momentum in the gold price validates the precious metals narrative, and the generalist investor comes down into the space, that generalist investor is tempted to silver because of its reputation for volatility, and I suspect because of its lower unit price. What that means from a practical point of view is that at some point in time in a precious metals bull market, when the generalist investor comes to the space, silver begins to outperform gold. That doesn't happen at the beginning of the market. It doesn't happen until the validity of the narrative is established by the gold price. But when it happens, silver moves further and faster than gold did. The most volatile asset class in the space is that very small number of silver stocks. My friend Doug Casey has observed that the aggregate market cap of the legitimate silver stocks is so small that when the generalist investor comes into the space, the silo can't hold the money. And you see these incredible escalations in share prices. In my youth, Coeur d'Alene mines going from 10 US pennies to 65 US dollars. Unfortunately, I was too young and poor and stupid to take advantage. But later on in my career, in the silver market that we saw in the early part of the decade of the 1990s, the price of Pan American silver went from, if my memory serves me correctly, 50 cents to $46. The price of silver standard went from 72 or 78 cents, I forget which, to $45. And these moves took place in 6 or 7 years. Uh, this is the realm of speculators. I can't tell you when it will happen. I can't tell you why it will happen. I can't even tell you if it will happen. I can just tell you that in 50 years of experience in these markets, that ultimately in a precious metals bull market, when the generalist money comes into the space, silver and silver stocks go crazy. This isn't a place that you would want to have the money that you had set aside for a child's college education. This is for that portion of your net worth, which is determinedly speculative. So I'll leave that caveat with your listeners.
On that note, I've also seen something that Tavi Costa and Willem Middelkoop were tweeting on X, and that was about actually the silver exchange for physical, meaning that there was traders that are currently swapping at record high levels, future contracts for the actual physical asset at record levels. What do you make of that?
There's risk there. The idea that on the average day, 200 times as much silver gets traded daily than is available for physical settlement is a recipe for a problem. I'll leave it there. That math I can do. If you have whatever the number is, $100 million worth of silver available for good delivery, and 200 times that trades daily. I'm not talking about monthly, yearly, daily. I don't participate in the futures market for a variety of reasons, but that is one. And that market is rife with short-term, not long-term, short-term manipulation. And people need to understand that if they go to the futures market. They better understand it if they're going to play that game. I don't play that game. I own physical silver. I own silver stocks. I have no interest in the futures market.
On a concluding note, I've actually, that ties a bit to like the naked paper, let's say correlation of 1 to 100 to maybe also the one that central banks themselves have. And in this case, Fort Knox. And I came across this article from a few months ago on Zero Edge where it was starting about a floor broker with deep ties to major billion banks that made a statement, and maybe you've heard about it, that Fort Knox holds nothing but muffs and half-eaten IOUs. And that was reflecting to the reserves that of gold that the U.S. basically has on paper lending to other banks, and that the moment those banks want to retrieve their actual physical gold, that actually nothing back is left there. And maybe someone that you actually know, Egon van Gerards, was saying that might be actually a problem if we look at bank reserves. What do you think of that?
It might be, but I don't know, and neither does Egon. And I don't need it to make my case. He needs it to make his. By the way, I respect him. But if you look at the aggregate value of the gold holdings, whether the U.S. actually has them or whether they don't, relative to the U.S. liabilities and relative to our federal budget, that gold, relative to our obligations, has the same impact that taxing the billionaires would have. It's an irrelevancy. I think the gold community makes a mistake in trying to focus gold adherence on these cataclysmic outcomes where they don't have any real evidence that would support the sort of conspiracy narrative that they put forward. Because you don't need to do that to encourage people to hold gold. All you have to do is point to the rational outlook being taken by the Chinese central bank or the Russian central bank. The why, in terms of U.S. government control, and the how around the difficulty between the interest that you receive in U.S. dollars and the depreciation of the purchasing power of the US dollar. That's all you need to own gold. You don't need some massive conspiracy in the futures market. You don't need to debate whether or not the US has the gold that they purport to have in Fort Knox. It's irrelevant to the outcome of the discussion. Interesting, to be sure. I like math. I've been a lender most of my life, and narrative is not collateral.
Thank you, Rick. I think we've just reached the exact hour that we had planned for this conversation.
If I might leave your listeners with one offer, anybody who cares what I have to say about natural resource equities, and by the way, we haven't done that yet. Maybe we can do it in the future. Are invited to go to my website, ruleinvestmentmedia.com. List your natural resource stocks. And for no fee, for no obligation, I personally will rank them 1 to 10, 1 being best, 10 being worst. Please, by the way, no crypto. Please, no tech stocks. Please, no pot stocks. Natural resources only. Ruleinvestmentmedia.com. List your natural resource stocks. I will rank them 1 to 10.
But you've also organized an event quite soon, in a few months. Would you like to also say a few words about that?
I actually don't have the time. I'm supposed to be somewhere prepared a minute ago, so I must go.
I'll put all the information in the description. Thanks a lot, Rick, and I hope we can continue on deep dives on certain of the topics we've touched upon on a future interview.
I've enjoyed this. I like visiting with you, and I like visiting through you to your audience. So I look forward to an invitation.
Thank you, Rick.
Thank you.